Welcome to this weekly macro and strategy update. Today, I would like to focus on the latest fiscal stimulus plan by the new US government. To sum up our views, we see the risk of an overheating US economy as increasing. Now, the new Biden administration unveiled a new fiscal stimulus plan totaling $1.9 trillion as a policy priority. Currently, Democrats in Congress are pursuing a reconciliation process for the so-called American Rescue Plan, which allows to pass certain measures with a simple Senate majority. We note the following couple of points. First, this is a huge, gargantuan expense and follows the $900 billion stimulus that was passed Congress late last year to fight the pandemic. It would raise the aggregate amount of stimulus packages to about 25% of US total output that existed back in 2019. Second, while certain measures like the $160 billion provisioning to accelerate vaccine production and distribution, as well as topping up unemployment benefits, are plausible, other priorities are harder to justify economically. As can be seen from the chart we show in this video, about a fourth of the planned spending is aimed at giving checks to most American households. To look at the numbers, these payments to households represent 26% of the current Biden plan, a significant rise from the 17% from the December stimulus. This raises the total combined cash infusion to around $650 billion or 3% of US GDP for this segment alone. We are doubtful of the economic merits of this precise measure for three reasons. While it increases short-term growth, a positive, giving checks to people does not increase the productivity of an economy. Besides, households' excess savings accumulated last year are already huge in the US. Second, given its huge size, if approved, it decreases the potential for a next round of fiscal largesse, which is planned to focus on infrastructure. Now, improving infrastructure is an important element for a more productive economy. Lastly, as economic growth is improving, the still negative output gap might close more rapidly. Even with conservative assumptions on the fiscal multiplier, this signals that the current plan, if implemented, might lead to a quicker closing of this gap and an overheating of the economy. Now, from an investment point of view, this raises the likelihood of reflation, and we remain prudent regarding US sovereign fixed income securities as well as the US dollar. Thank you for your attention and see you next week.